Hello, welcome to Any Answers Answered for September 2018. Hopefully everybody had a restful summer and is ready for the fun and games, inevitably, which will come between now and the end of January 2019. As ever, Tim and I have had a look through the pages of Any Answers and come up with a couple to have a look at. Our first question is an anonymous poster relating to overlap profit in the final year of trading. He is a partner in a firm. We had a very good first year, such that I have a large amount of overlap profit. I will be leaving the partnership this month, but we have had a poor earnings year, such that my tax will be much less than the overlap profit originally paid. Can I apply to get the residual relief back, or will it be lost to HMRC? Is the question.
Well, interesting that it's only had one answer, and that was your accountant will be able to help you on preparation of your tax return, blah, blah. So it hasn't generated a great deal of interest, but we've chosen to cover it in this piece because I think it's too easy to overlook the availability of overlap relief. And one particular problem that I've talked about in the past is that if an agent takes on a client from a previous firm of advisors, they do need to make sure that the overlap relief is identified because it's quite easy to lose it in the mists of time. Some overlap relief, my own, dates back to the introduction of self-assessment back in 97-8 or 6-7. So we're looking at 20 years ago. And I've used up some of it when we changed our accounting date from 30th of June to 31st December, but I've still got 3 months worth of that overlap relief being carried forward. So the first thing is identify the overlap relief. But if, as is quite often the case, on a cessation of trade or a retirement here of a partner, the taxable profit or the profit in the final basis period is lower than the brought forward overlap relief, that does create a loss. And that trading loss is then available for use in the same way as any other trading loss. So it could be used against total income of the year of the loss or the previous year, or it could benefit from terminal loss relief. And that's what the poster of the question needs to be told, that they are able to get the unused overlap relief available against earlier years' profit, so making the appropriate claim there. But one thing I particularly wanted to mention, which is why I have chosen to talk about it today, is that in some cases, this excess overlap relief creates a loss on a cessation or retirement where there's an incorporation. And we should then remember Section 86 of the Income Tax Act 2007, which allows an unused trading loss, including one generated by excess overlap relief, to be carried forward and used against income generated from the company to which the trade is transferred. If the individual, sole trader or partner becomes a director shareholder in the company, obviously there are various conditions that have to be met, but you can then offset the unused trading loss from the unincorporated business against future remuneration or dividends that you get from the limited company. And that's a very useful way of protecting the value of that final loss, even if it's created by overlap relief.
And I think one of the important things in a situation where that isn't a possibility, perhaps it is a genuine full cessation of the business, an awful lot of people, as you say, will only look at their overlap figure on the last day. Okay, we now deduct this figure. Oh, it's a loss, never mind. You need to look much earlier, particularly in a time where quite a few people these days will reduce the amount of work they do for those perhaps final 3 or 4 years before finally retiring. And it could be that actually even with terminal loss relief, you just don't have the levels of profit. And even if you do have enough profit set against, you would only be paying it perhaps 20% on those profits, where previously you could have used it with a year-end change, something like that, at perhaps 40 or 45%. So hugely important that that is considered. Our second question this month comes from Mr. Bailey. Mr. Bailey has asked a question on the annual investment allowance and how it relates to groups. I get the feeling, he says, that where you have a company which owns 2 others, that only one annual investment allowance is allowed. Is this correct? If so, can the limit be shared? Does a group only get one AIA, and can they share it out?
Yes and yes, and I'm just a bit sort of confused as to what's going on the thread here, because I don't know who Mr. Bailey is, but nobody has given a substantive answer to his question, but there's a suggestion that he's simply using accountingWEB as some sort of surrogate private tutor for his exam studies. But be that as it may, the availability of the annual investment allowance is an important point. 200,000 a year, but as you say, it has to be shared, not equally, it can be divided howsoever they like, between companies under common control or companies that are related, or businesses I should say that are related, and the rules are a little bit more complicated than at first sight. Let's deal with it by example. Suppose that you and I are the controlling director shareholders of two companies, PTP Training Limited and Absolute Accounting Software Limited, and we are also partners in a professional firm, the Professional Training Partnership. I say let's suppose.
Because we are.
Yeah. Can each of those businesses qualify for the 200,000 annual investment allowance is an important question. Mm-hmm. Now, the first and very easy part of the answer is that you don't have to look at unincorporated businesses and companies controlled by the same persons together. So we can separate the partnership, which is unincorporated, and if that's the only business that we control, unincorporated, it gets a full 200,000.
Okay.
We then move to the two companies. They are not in a group. They have different shareholdings between us, and those two companies are not in fact under common control, but they are controlled by connected persons, which then brings them within the common control definition. Mm-hmm. And that would mean, unless we can get out under one of the provisions, that we do then have to share the 200,000 between the two of them. But we do at least have two lots of 200,000. Now it's possible there are three, because it may be that the two companies are in fact not in any way in related business. And the revenue manual gives some quite good examples here. There's an example of a woman that owns a hat shop and a shoe shop. Now those are two unincorporated businesses, but because they're carrying on similar activities, retail sales, and would be under the same NACE classification, those are the codes for what type of business you're in, they would in fact have to share the 200,000. But if she had one of those as a company and the other as an unincorporated trade, they wouldn't. The revenue give another example, which will be interesting, of a farmer who has a farming business, and on the farm he has a furnished holiday letting. Now, if they share premises, then they're going to be treated as related, and you have to share the annual investment allowance. But even if the books are written up in the farmer's living room for both businesses, the revenue accept that that doesn't count as sharing premises, and in fact each of those would be eligible for a full 200,000. So there's quite a lot to it, and I don't know whether Mr. Bailey was looking for that sort of tutorial guide, but I think it's worth drawing our viewers' attention to the way in which the annual investment has to be divided. And of course Osborne, when Chancellor, fixed it at 200,000, so that's now become something of a fixture. And
the point is, as you also said, we can allocate it as we wish, so you do need to watch out for which businesses are buying and selling things and where it should therefore be allocated to. Well, hopefully useful to the two questioners and also everybody else. We will continue to have a look for questions on accountingWEB, so do keep posting them. We will have a look, and perhaps next month it'll be your question we're having a look at. But for this programme, bye-bye.